All right, good afternoon, everybody, and welcome. And thank you for joining us this afternoon. What we'd like to do today is really just have a punchy session, check in with our clients, and just talk about the markets, where we are at the moment, and where we would like to position portfolios, or where we think portfolios should be positioned for the next decade or so. So, in essence, there's two parts to the story today. It's around just navigating the current turbulent times, and then again how we position those portfolios for the next 10 years. I'm joined today by portfolio managers Andrew Padoa and Mohammed Wagley. My name is Craig Pfeiffer. I'm the Chief Investment Strategist, and we all work together here at Sasfin Wealth to the best interests of our clients' portfolios. So I'm going to kick off. Mo, if you can put us on the first slide, and maybe just position where we are and how we got to the point we're at today. So a very colorful little presentation of maybe some bleaker events in the market at the moment. But over the last, let's just say the last 2 years or so, we have experienced the COVID pandemic. We seem to, in South Africa, think that it's all over bar the shouting. It seems we had some kind of a fifth wave that we may still be in, and but the infections may have picked up, but we're seeing that deaths are a lot lower in this wave. But nonetheless, I think all the trouble started with the pandemic and the fact that we had to lock down economies and hunker down in our houses, and that caused economies to slow down and almost come to a standstill around the world. And that had a couple of implications. One of them was that things, widgets, businesses weren't working and things weren't being produced, and that has created a bit of a disruption to the supply chain. If we think about building cell phones or computers, that process stopped a bit, but the process of building computer chips stopped. So there's a global shortage of computer chips at the moment, and that the world is still working through. And that shortage of goods and a couple of those components that we need in the supply chain have created that shortage. And given that demand is still quite strong for those things, we all want our phones and our tablets and our TVs, and I'm just using that as an example. So the demand is still there, but the supply has been disrupted, and there are shortages, and that's been one element that's driven up prices, and we've seen inflation tick up as a result of that. Going back to COVID, we're seeing in China there's a very harsh clampdown on any infections that come up. We've just seen Shanghai being in strict lockdown, as we did in those early days, banished to our houses. And again, that's 2022 now, and we're seeing that happen in a massive global center like Shanghai, with ramifications for trade, just for general business, and that in itself has maybe exacerbated further supply chain disruptions that might come down the line. Shanghai seems to have come out of that lockdown now, but Beijing looks to be the next city that's experiencing some of those tighter lockdowns. Along with China, or talking about China, they've also in recent times, and I think over the last year or two, been clamping down a lot on individual companies. Maybe they think that some of them have grown a bit too big for their boots, and maybe just doing things a little, I won't say untoward, but not in the general interests of the population or people. And the Chinese authorities have looked to all parts of their economy, of businesses, of corporates, to kind of weed out any kind of abuse of citizens or poor treatment of people. And that goes down to your delivery guy with the food delivery, who may be being underpaid, to regulations in the technology space around mergers and acquisitions, antitrust, and just ensuring that nobody's exploited along the way. That, of course, has had implications for a lot of our big, technology firms, particularly those that operate or sourced in China, and maybe hampered a bit of their business activity, and that too has come through in the markets and in share prices. So that's been a bit of a dampener on some of our big technology stocks, like Tencent in particular. Alibaba really came and experienced a lot of their wrath. Going back to that global lockdown of economies that we saw in the first part of 2000, with economies slowing down to a standstill, we saw the world go into recession, and that prompted the monetary and the fiscal authorities to try and re-engineer growth, and apart from paying huge fiscal packages or just actually sending people checks in the mail to go and spend, we saw interest rates slashed to zero in most of the large developed economies, and along with that, what came to be known as quantitative easing, where the central banks just, in essence, printed money and bought bonds, assets in the market, to try and get more cash into the hands of the banks to get them to on-lend, and when with people and corporates borrowing that money, then spending it and getting the economic engine turning again. So we saw a huge, massive, and the superlatives escape one here, for the size of the policy loosening that we saw here, and the amount of liquidity that went into markets and the economy to try and stimulate demand and get economies right-sized again, or righted again. That policy, fiscal and monetary policy, certainly did its work. We saw economies bounce back very sharply in 2021, and now sort of moderating in 2022 as things normalize a bit more. But one of the consequences of all of that easy policy was that a lot of that liquidity found its way into the equity markets, and we saw record levels of the JSE, the S&P 500, and markets around the world. Economies improving, we saw unemployment falling, more and more people being employed, so more cash to spend, and in that environment where we have those supply shortages, that increased demand also led to was one of the factors that are driving that higher inflation. And then to top it all, we had Russia invading Ukraine, and that cut off a huge supply of oil to Europe, and that whole debacle now has created shortages in global supply, and in an environment where there's still very strong demand. We all know what's happened to oil prices and fuel prices, and we feel that pinch every time we fill up at the gas station. So all of that has fed through into higher producer inflation, and that's also made its way into consumer inflation, as producers and manufacturers have passed that on. Higher shipping costs have also come about, so trade globally is more expensive, and also Ukraine, we have lost out on some of their food production or their agricultural production, so we've seen food prices also on the up and up. So with that rampant inflation and central banks wanting to really normalize policy again, get back to some kind of a steady state of equilibrium, from the US inflation rates of 8% with a target, long-term target of 2%, they started tightening up on monetary policy. And perhaps they started tightening up a bit too late. They thought inflation was going to pass by, fairly quickly. And they found themselves really behind the curve, and now have started to hike interest rates at a really, a much faster pace than anticipated. That increasing rates has seen bond yields rise in the US. It's seen US equity markets a lot weaker. A lot of your technology stocks, where cash flows are really only going to be seen in many years to come. The strong cash flows, the strong earnings, those stocks have been hurt to a greater degree with rising interest rates, and that's seen indices like the Nasdaq down almost 30% this year so far. So weak markets has been one of the fallout that we've seen from this tighter policy, and another's been a strong dollar as well, as the US has put up rates quicker than everybody else, and we've seen a flood of funds into the dollar at the expense of other developed market currencies and the emerging market currencies such as the rand as well. So even though we've had a good current account surplus, our fiscal balance has also improved quite a bit. The rand has really just weakened up against a very strong dollar, and that has also given pressure to our own inflation rate. But the key takeaway from all of this is that when we look at the markets, we've had a lot of these things happening. The famous American-born British investor Sir John Templeton said, the four most expensive words in the English language are "this time is different," and we seem to sometimes think that we've never seen all of this stuff before. The markets are weak. What on earth is happening? And Templeton's quote there was really trying to point out that the markets generally have seen all of this before in different guises, and it's nothing new. What may be new is just a confluence of all of these different crises at the same time: the health crisis, the tightening policy, the war, the oil crisis. But we have seen all of these things before. The markets experienced them all before. Pandemics, we've had, apart from COVID, we've had Spanish flu, Hong Kong flu. We've had the AIDS pandemic of the 80s. We've had a number of these. The markets digested all of those. We've had numerous wars, and you can pick your favorite there over the last 100 years. We've had oil crises, particularly in the 1970s. In 1973, we had the oil embargo following the Yom Kippur War, and in 1979 we had the Iranian Revolution. After that, we had another oil crisis. So we've seen these crises before, along with rapidly tightening policy, higher inflation rates, and the like. So if we look at this graph here of the S&P, this goes back to 1975. There's been all kinds of global incidences, geopolitical events, and the market has fallen, and we've had some huge knocks to the market. But those that have stayed the course have seen this, have seen the markets recover in time, and over that time go on to new highs. Not on this chart, but if we just see probably the year or two before it starts, somewhere around 1973, 1974, we had a US bear market that knocked almost 50% off the S&P, and it took a little bit of time to recover, but the S&P 500 at that point in time traded down to 65 points index points. And if you look at this graph now, we traded up to a high of just under 4,800 at the beginning of the year, and are trading just below 4,000 at the moment. So I think the takeaway here is that there are a lot of things going on at the moment. They seem overwhelming, all of these different crises, but we've seen them before. It's not new to the market, and we just have to bide our time here and just digest all of this, and in time we will see markets improving once again. Next slide, Mo. One of the things about investing in the market and trying to stick it out for the long term is looking to stay with quality companies. So we do all of our work and research and try to find those big brand, big name companies where we see value in those companies. We see good growth expectations for earnings, potentially dividends, buybacks, the like, anything that's going to add value to clients' investment portfolios over the longer term. I'm going to hand over now to my other colleagues who are going to take us through a couple of themes that we're looking at that might serve us well for the foreseeable future, for the next 10 years.
Thank you very much for that, Craig. What I'd like to do now is discuss some of the long-term themes that we invest in, and maybe give you guys a bit of an idea as to sort of why we expect these trends to continue in the future. So the first theme that I'd like to go through would be that of semiconductors. And really the first thing that I'd like to note is this is almost like a catch-all term that encapsulates further themes of cloud computing, artificial intelligence, computing, enabling, among other things. And this is really just due to the pervasive nature of semiconductors. They're used in your cars, they're used in your smartphones, they're used in medical technology, they're used in robotics. It really is pervasive and used in many, many different sectors. Now, to give you an idea of the growth of this industry, I'd like to illustrate with an example. On the bottom left corner here, I've got a picture of the first computer invented. This was called the ENIAC, and it was really made for the purpose of projecting artillery distributions for the US military. Now, what the ENIAC was able to do was make these projections accurately within 30 minutes, whereas it would take a human roughly 20 hours or so to make the same projections. Now, over time, the semiconducting technology has developed to the point where really any smartphone that can run Candy Crush or Angry Birds can easily make the same projections in a split second. The company that we really like at this space is a company that's found itself really well entrenched at the top of the semiconductor supply chain, and that company is ASML. Now, what ASML does is they create these massive machines that they sell to companies that design and manufacture semiconducting microchips. Those microchips are then used by our phones and computers. Now, just to give you sort of a more practical example, if you've got an Apple smartphone, the company that manufactures their microchips is called Taiwan Semiconductors. But the company that makes the machines that Taiwan Semiconductors uses to manufacture these chips is ASML. And similarly, if you had a Samsung, ASML again makes the machines that they use to manufacture the microchips as well. So in essence, ASML has quite a monopoly in this space. Their competitive advantage lies with their extreme ultraviolet technology, which enables them to add extremely small structures to their silicon microchips. And these structures are really small. The naked eye cannot see them. Or some of these structures are smaller than a red blood cell. And essentially what this allows them to do is that the smaller the features of the microchips, the more transistors these manufacturers like Taiwan Semiconductor and Samsung can fit on the chip. And as a byproduct of that, the more the chip can do, the more computing power it has. So it's taken ASML roughly 3 decades to build this technology. And, truthfully, we don't see anyone able to catch them, at least not anytime soon. Competitors just don't have the time, they don't have the capital, and they do not have the intellectual resources required to catch ASML. So I'd say that this company is perhaps one of the most important companies in the world, and most people have actually never heard of it. Just moving on to the artificial intelligence space, graphics processing unit producer NVIDIA is the dominant player here and our pick. Their innovation in the GPU in '99 is really credited with the growth of the PC gaming gaming market, really as an alternative to consoles, and that was just because of the power of the processing units as well as the graphics, which were really comparable and held up quite well relative to the consoles. Today, it's a bit different. NVIDIA's GPUs effectively serve as the brains of computers. They're essentially able to compute, perceive, and I think very importantly, they're able to learn from the world around them using machine learning. The applications of this technology is massive, with GPUs being used in computers, robotics, and self-driving cars. Today, their chips are helping farmers identify weeds as tractors drive over crops. They're helping doctors detect diseases in patients, and they help warn communities of natural disasters almost 5 times quicker than current weather forecasting models. Now, by all accounts, this technology is still in its infancy, and it's very likely that spending on these technologies will remain quite high over at least the next decade. So the next theme that I'd like to take you guys through is one that I think everyone will be a little bit more familiar with, and that's really just because of how pervasive big tech is in our day-to-day lives. Now, to put it into context, everyone attending this webinar currently would have in some way or the other invested in this theme, whether that be using your Android or Apple smartphone, your Microsoft-enabled PC, or your tablet running iOS. In some way or the other, we need to be invested in big data just to do something as simple as attend this webinar. Now, the trend here is, well, has been prevalent for the past couple of decades, and we do expect that to continue growing. Take Alphabet, for example, which is the holding company of the world's biggest search engine, Google. You know, they've got a roughly 90% of the market share in the search engine space, which is almost complete domination. And, you know, the bulk of this company's revenue is generated through ads. So essentially the way it works is companies pay for their adverts to come up right at the top of your search result. And very simply put, that's how Google makes most of its money. Now, what the companies, or rather Alphabet makes most of its money, and rather what the company's now done sort of to leverage off the success of Google is to invest sort of in other tech companies. And I think there's been about 200 acquisitions since 98 when Google was started. But I think the noteworthy ones are Android, which is the software which you run on your phone, and then YouTube, which is the second most visited website in the world after Google. I'd like to then move over to Microsoft. And I think this one is a little bit different to the companies that I discussed earlier, because I suppose the key point here that I want to go over is the capacity of this management team and how great this management team was at sort of restructuring their business. If I had to show you a list of the top 10 companies in the United States in 2002, and I had to compare that list relative to today's list, there's only one company that will have survived that list, and that company is Microsoft. And in my mind, this really speaks to the management's capacity to remain sort of fluid in the face of changing external circumstances. The gentleman at the bottom is current CEO Satya Nadella, and he was hired in 2014. And when he came in, it was sort of a big part of his mandate was to sort of reposition Microsoft at the forefront of growth, you know, a position which they had enjoyed previously. And Mr. Nadella identified the cloud computing and mobile divisions as potential sources of growth which they could go into. The latest results from Microsoft show that the cloud computing division grew 35% from last year, which is a massive growth, and it's really a key growth driver there. For a software business like Microsoft with limited supply chain exposure, we really do think the company will find itself really well positioned for growth going forward. On that note, thank you guys very much for listening. I'm going to pass it over to my colleague Andrew, who'll go over the themes of digital payments and healthcare.
You call Visa and MasterCard the toll booth between the shopper and the merchant. So instead of going to the shops and buying something with cash, if you pay with your bank card, or even if you purchase something online, it's either Visa or MasterCard that are enabling you to purchase your goods via your bank accounts. There are over 3.5 billion cards worldwide linked to Visa in over 200 companies. They are the biggest payment technology company in the world. Visa and MasterCard are the poster children for high quality businesses. They have strong and predictable earnings growth, high returns on capital, high operating margins, and they work in an industry that has significant growth opportunities. Visa's operating margins have averaged at 66% for the last 5 years, and MasterCard roughly 55%. You could halve their operating margins twice, and their margins would still be above average for an American company. It's really, really incredible. With the amount of transactions Visa and MasterCard process every year, they have unmatched scale, making it extremely difficult for competitors to come in and take any market share away from them. The rise of e-commerce has helped Visa and MasterCard grow, and COVID has accelerated this shift to e-commerce and digital. However, more than 80% of retail transactions globally are still cash-based, so Visa and MasterCard still have plenty of room to grow. COVID has highlighted the need for healthcare broadly. There are significant sums of money being invested into healthcare technology and medical research. The baby boomers are retiring, and most of them want to remain active. They want to play tennis, they want to play golf, play bowls, and be able to run and cycle. The healthcare sector is well positioned to take advantage of this trend. Healthcare is not only a defensive sector, as we all need healthcare, but it has attractive growth opportunities. Now, within healthcare, you have a few different subcategories. You've got pharmaceuticals, you've got medical technology companies, you've got health insurance companies, and the life sciences. So what I want to touch on today is the medical technology area, as well as the life sciences. So we saw an article at the end of last year on News 24, and the article was about how Groote Schuur Hospital in Cape Town received their first robot surgical system, and they started operating with it at the beginning of this year. They received the Da Vinci surgical system, manufactured by Intuitive Surgical, and it's the global leader in soft tissue robotic assisted surgeries. This surgical system has already been in the private sector in South Africa for some time, but Groote Schuur is the first government hospital in Africa to receive this type of robots. We've also seen that Tygerberg Hospital in the Cape have also recently started to use it. So in the past, surgeons made large incisions in the skin and muscles so that they could directly see and work on the area of concern. So if you had an operation on your stomach, for example, you might have a cut from your chest all the way through to your groin, and that's called open surgery. Today, doctors still perform open surgery, but can also perform many procedures using robotic assisted surgery or minimally invasive surgery. So this minimally invasive surgery only requires 1 or 2 small incisions that the doctors use to insert surgical equipment and camera for viewing. This helps speed up the time of the operation. It gives surgeons more flexibility and control. And very importantly for patients, it speeds up recovery time. As I said, Intuitive Surgical's Da Vinci robot is the leader in the soft tissue sector. So soft tissue, that's just your general surgery. So we've got a picture of it there of the Da Vinci robot with the surgeon operating on the top left of your screen. Medtronic have launched their version of the soft tissue robot assisted surgery, and it's called Hugo. And they should take market share from Intuitive Surgical, as hospitals do not want to only use one supplier. So Hugo is on the top right-hand side of your screen. And on the bottom of the screen, you've got Stryker's robot-assisted surgery equipment. Stryker is the leader in the hard tissue robotic-assisted surgery. Now, when I talk about hard tissue, I'm talking about bone. So think of hip replacements as well as knee replacements. Their robot is called Mako. And one of my colleagues in Durban, her mom had a knee replacement at the Hilton Hospital just outside of Maritzburg about 2-3 weeks ago. And it was Stryker's Mako robot that was used to perform the surgery. And she was walking within 3 hours after the operation. Robotic assisted surgery is likely to become the norm in the next decade. Abbott Labs is one of the world's leaders in medical technology. They don't have robots to assist with surgeries, but rather they've made huge progress in the diabetes space. So their diabetes device is called Libre. Libre is the small white patch that you possibly have seen diabetics wearing on their arm. Instead of requiring a finger prick to get glucose levels, this device monitors your glucose levels every minute and gives the feedback back to the application on your smartphone. It's arguably the most successful medical technology device of the last decade. There are 400 to 500 million people in the world diagnosed with diabetes every year. So diabetes is an area that needs to seriously be addressed. Earlier this year, Abbott announced the development of a category of wearable biosensors called Lingo. So these sensors, which look very similar to the Libre, are being designed to track a person's macros on their smartphone. So they've used the technology that they obtained in their diabetes work to help people, whether it's pro athletes or just the man on the street, to make better decisions regarding their health. The goal of Lingo is to provide extensive insights into a person's metabolism to help those without diabetes make better health, nutrition, and exercise decisions. So Abbott worked closely with Eliud Kipchoge to optimize his training in preparation for his sub-2-hour marathon attempt back in 2019. And as the runners on this webinar will know, he broke the 2-hour marathon time. So he's the only person in history to have done this. And as you can see in the bottom left, there's a picture of him training with his lingo sensor on his arm. And finally, onto the life sciences. So new drugs are coming onto the market faster than ever before. There were an average of 29 new drugs per annum approved by the FDA from 2007 to 2016. And that number has increased to 51 per annum over the last 4 years. There's been 190 biopharma businesses listing on global stock exchanges since COVID began. Many of them are still in early clinical stage trials, so it's very difficult to know who the winner is going to be. The safer play is to invest in the equipment manufacturers who supply the tools that are needed by these biopharma businesses. And that's effectively what Danaher and Thermo Fisher do. Someone said to me a while back that, during the mining boom, it wasn't the mining companies that made the most profits. It was the companies selling the picks and shovels to the mines. Danaher and Thermo Fisher are effectively the picks and shovels to the pharmaceutical industry. These companies were beneficiaries of COVID, so their revenue may slow down slightly over the short term. However, these businesses have long-term durable growth with large amounts of money being invested into R&D for other drugs and vaccine development. The key point I want to make here is that there are still many companies growing their earnings and doing innovative things despite the macro environment. The companies we've highlighted in this webinar are good examples of these. Our clients own many of these companies in their portfolios already, while some of the other companies are currently under consideration for inclusion. However, even the best companies can take a knock from time to time when the market is just sold off indiscriminately. And we're experiencing one of these times right now. But is this time really different to anything we've ever seen before? Thanks very much, Craig. Over to you.
All right, thank you very much, Andrew. I'm going to conclude and chat about whether this time is different or not. We do have a chat facility where you can ask your questions, and we'll try and work through them and give you some answers. But looking at the markets and considering those famous words, this time is different. I think I highlighted at the start of it all that we've seen these various individual crises before. The markets have gone on to greater heights, and it's really been about just staying the course. I've got a couple of examples here from the recent past, from the last 20 odd years. We remember the dot-com bubble, locally, and these graphs are just on the FTSE JSE All Share Index. During that dot-com time, over the space, we had a very sharp fall off, but over the space of a year, the markets lost 28%. Sorry, not a year. In this case, it was about 3 months. We lost 28%, and then it took about a year for the market to recover and then move on up and continue its higher path. And if we go back to those days, you probably won't be able to see the indices there, but we got down to below 6,500 on the All Share Index, and that seems like a very long time ago, back in 2000. We had the Enron and that whole accounting scandal. The markets lost a third in the space of just under a year. It took probably 2 years to recover, and again went on to new heights after that. The JSE at those times, at the bottom was probably around 7,500 index points. In the more recent past, the global financial crisis and the associated Great Recession, those were dark days indeed for the markets. We lost, nearly 50%, half of the value of the markets in just 6 months. And it did take, some time. It was a grind the next 4 years or so to get back to where we started. But again, even at that point in time, once we'd recovered, we got to an index level of about 33,000, and that it doesn't seem so long ago. And the market, even after after it's moved back in the last little while, is still double what it was before the start of that financial crisis. and certainly a multiple of where we were at the bottom of that crisis. The lockdown, that saw the market lose a third of its value in a month. That took more than a year to to recover from, but we did, in a shorter space of time, at least recover about 90% of those losses. And I think these are just some examples. We've seen other market collapses, other market crises, going back over time. Black Monday, the original Black Monday and Black Tuesday of the Great Depression, and the markets, sometimes they recovered quickly, sometimes it took some time, but they went on to new heights and created value for portfolios over time. So we love quotes in the markets and adages, and we always they always roll off the tongue quite easily. And I did suggest, or I did tell you about Sir John Templeton's quote. This time is different, being those four most expensive words in the English language. I'm going to just close off with a quote of his here that I think is pretty insightful and probably appropriate for the current times. And when we talk about the current times, the market this year is probably only down, the JSE down in single digits, probably closer to 10%. But it seems like a lot of doom and gloom, particularly when the Nasdaq's down 30% and the S&P's down closer to 20%. But so John Templeton said that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and then they die on euphoria. And I don't think we are anywhere near maximum pessimism at the moment to start the next bull market. We may have a little way to go still, but I think if we look at the US, we more than likely, this time next year will be close to the top of where the peak of interest rates could be, or very close to that. So I think we're not at the point of maximum pessimism, but it's really incumbent on us as investment managers and on clients with investment portfolios to really just hold their nerves, retain your quality portfolio of shares, and use any opportunity that you see in the market weakness, to maybe tweak your portfolio around the fringes, or take up those individual portfolios. But it's more a time when markets are doing crazy things is more likely to sit on your hands. And with that, I thank you, and I will look to the questions and answers here. And thank you for those that have asked us a couple of questions. So the first one I've got here: what is your outlook of cryptocurrency investments? And this is a famous one. I think we have for some time tried to steer clients away generally from cryptocurrencies per se, or warn of the dangers of or the unknowns of cryptocurrencies, and investing in particular cryptocurrencies, individual coins, with the knowledge that blockchain, or the expectation that blockchain or the technology around it will be the driver, or the longer lasting outcome, and the application that will be more broadly used. Local banks are looking to use it, and just that the whole technology around cryptocurrencies is what's going to prevail over the longer term. And I think that's one would have no doubt about that there's a future for blockchain technology. The cryptocurrencies themselves, I think, are getting, they were the subject, or the source, or let's say the destination of a lot of that market extra liquidity as well. That also drove prices up, along with shares and other other asset prices. So I think in a long-winded way, I'm saying that potentially, it would take some time for those to recover as well, but they remain and always be fairly speculative instruments. We saw Christine Lagarde this week as well saying, there's actually no value to cryptocurrencies. There's nothing behind them. There's no real fundamentals to drive it other than scarcity or perceived scarcity. So I think they remain speculative, and they may bounce back, but I can't see the fundamental or the catalyst to really push them forward from this level, other than when you get more people inspired to speculate further. There's a question here talking about the recovery. What will be the key drivers this time around for recovery? And I think I'll just take that one. I think that we need to get past this point of interest rates tightening. So when the market can see over the edge, that we've reached the peak or are nearing the peak of the interest rate cycle, the monetary policy tightening cycle. But if we look at the decline in markets, there's probably two parts to it. The first is the tighter monetary policy that's pushed up interest rates, that's reduced valuations, and has seen the market derate. We've seen PE ratios, price earnings ratios, fall, across the markets, and potentially we've seen the higher interest rates, a lot of that, and the expectation of high interest rates already in the markets and resulting in that derating. There may be a bit more of a second leg to the weaker markets, and a bit more of a derating when one looks at the slowdown in earnings growth. So when these slower economies actually feed through into lower earnings. So we still see positive earnings growth coming through, but I think the market needs to get to a point where it's happy with the level of earnings have landed, and where they're potentially going, and hopefully will be growing further. So again, I don't think we're at that point just yet. The market's still trying to fathom whether earnings are going to fall off a lot more. But once the market's anticipated or thinks that we're close to a peak in interest rates, and also that earnings growth has slowed sufficiently and is potentially going to pick up from there, then I think we'll see markets trying to find a floor. But I think at the moment volatility will likely prevail for some time. And maybe I can pass this one on to you, Andrew. I'll read it to you. Can one convert one's local portfolio into the international one that was shown? And do you provide a management facility for this as you currently provide for your local portfolio?
Yeah, thanks, Craig. The short answer is yes, absolutely, we do. I think Sasfin actually manages more money overseas than we do on the JSE. What I would suggest is if you get in touch with your contact at Sasfin, your portfolio manager, and discuss it, and they can assist. Thanks, Craig.
All right, thanks very much, Andrew. There are a couple more questions, and we will try to get back to those with some answers, maybe individually to those people who have posed questions. So we thank you for those. We did say we will cut off at 12:45. Maybe we've been talking too much, but we really do appreciate your time. And as I said up front, I think this was just an opportunity for us just to touch base, tell you our latest thinking, and I think by and large also just to stay the course, and we will see these weaker markets out in time. Thank you very much, everybody.